What's up, world? Michael EJ here, coming to you with another video in the fields of finance, business, and life. And today I would actually like to talk about valuation methods and the typical companies that come through. What is your valuation weakness? How do you look at companies? How do you pick companies? And what are the kind of companies you're going to end up investing in depending on your valuation method? Very important concept a lot of people really don't think about. They don't think about whatever valuation method they choose will actually lead to what kind of companies they're going to end up investing in. And if they're comfortable with that, that's fine. But you got to know what you're getting yourself into. So with that, let's get started. Now, I've chosen a couple of popular ways to value companies, and I'm going to walk through exactly what you're really getting if you're going to value a company and choose your investments in a certain way. So let's start with the first and probably most popular way of investing: price to earnings ratio, PE. That's everybody's go-to. You turn on CNBC, if you look at various YouTube channels, various blogs, various investors, everybody loves the price to earnings ratio. I feel like it's slightly overrated. It's not as helpful, but we're still going to talk about it anyway. Because one rule of thumb with the price to earnings ratio is look for companies that have that price to earnings ratio lower than the market, if not even with the market. So always look for companies with that lower than the market price to earnings ratio. That's good and all. I mean, because you're going to probably find some really interesting things, but one thing to keep in mind is that companies are valued where they are for a reason, most of the time. The market is mostly efficient. So if a company has a low price to earnings ratio, for example, right now in today's market, price to earnings ratio may be around 15, 16 times. If it's that low and the market's in the low 20s, it's mainly for a reason. And it usually has to do with earnings growth. I mean, if you're going to use price to earnings, you got to check earnings growth of these companies, because a lot of companies you're going to end up with are slow cash cows. They're more mature companies that not a lot of growth is happening. And you got to remember, the market is willing to pay for high quality growth. And even if the company's high quality, if they don't have growth, the market's they're just not going to pay for it. They're just not going to rise everything up. Now, if you're comfortable with that, that's fine. You just got to know what you're getting yourself into. Another popular multiple is price to sales, BTS. I mean, it's probably my favorite. It's the one that kind of intrigued me the most in terms of valuation multiples. You also have to realize with low price to sales multiples, maybe below the market usually has a 1.3, 1.5 times price to sales. If it's lower than that, usually it's because the company isn't really profitable at this moment or at that time. I mean, a lot of price to sales is connected with margins. So you have to pay attention to what the margins are of that company before just blindly looking at the price to sales and making that your sole judgment or your primary decision. And also, keep in mind, both price to earnings and price to sales may be low for a reason. I've mentioned this in other videos that when you're looking at multiples, you got to think about, why is this multiple so low? There's two reasons. Either the company isn't growing, not really growing earnings, or not growing at a fast clip, so little to no growth, or the company is risky companies. You're actually taking more risk on and looking at lower multiples. People just go oblivious to that. They just completely forget. They don't think about it from that direction. Now, again, if you're okay with that, if you think that risk is going to pay out in the long run in certain investments and certain stocks, then so be it. That's the risk you're taking. Just know what risk you are getting into. That's the most important part. Now, it's really easy to point out what's going on with multiples. I mean, that's not that bad. Intrinsic valuations are much tougher. Number one for that is the DCF, discounted cash flow valuation. Now, there's a lot of people who have problems with it. A lot of people think garbage in, garbage out. You can create whatever you want in DCF. I don't necessarily think about it that way. The DCF to me is powerful because it considers the entire company. You have to consider both the investment side, the balance sheet. You have to think about those things in the DCF, and most importantly, how much cash is being generated and how would that company use that cash in the future. I mean, theoretically speaking, the value of a company is the present value of their future cash flows, right? So why aren't more people using DCFs? Maybe it just involves too much time, too many inputs, I don't know. But for those who are, you also got to consider different things with DCF. I mean, in the DCF, you're going to probably end up similar to price to earnings. You may end up with more mature companies that are slow growers but have high free cash flow margins. So they're producing cash at a high rate. They're just not growing. And there's times where that's fine. There's times where that might work against you. So you have to be comfortable with that. Also, DCFs actually favor technology stocks in a lot of ways. A lot of these technology stocks nowadays, they are pumping out cash because they're capital light. You know, they don't need that much capital to really get themselves going. So if a technology company is in the red, it's usually not coming from expenditures on the capital side. It may be marketing, it may be personnel, and those things could possibly change in time once scale is high enough. So that's another thing. I mean, DCFs are good for that if you're okay with that. Now, to mitigate some of the risk and kind of diversify other companies you'll be invested in, my biggest suggestion for the DCF is actually lowering the discount rate over time. And the reason I say this is that when you are calculating the discount rate for different companies, bigger companies usually have a lower discount rate because there's lower risk. Smaller companies or unprofitable companies, higher risk, right? So if a smaller company can become a bigger company, all of their risk decrease over time. Not by a lot, but by a little bit. Maybe by a lot. Who knows? It's case by case. Perfect example is maybe a company is 2 years away from being cash flow positive. So right now, first 2 years you have them at a 15% discount rate. Year 3, you have them becoming cash flow positive. You drop it down to 13. And then from year 3 all the way to year 10, your forecast horizon, you have it drop from 13% all the way down to 10%. As the company maybe expands and sales go up maybe 3x, 4x over the next 10 years. It's just a different thought. Have decreasing discounting rates. And you'll be surprised how many companies actually pass through the DCF. You have more ideas to work with than just very mature cash cows and technology stocks. Even for myself, what I've created, PVGO, present value of growth opportunities, valuation framework that I've used, I've created, made plenty of videos on in the past. In using it, I actually favor those companies that are making a lot of investments in intangible assets. If you're investing a lot in technology, you have a lot of investments in R&D, I give you credit. I like to see those things. That's important to me. But I even have a bias. My bias is companies that are doing all that investment. Sometimes very young startups type of companies, they'll pass through and I'm unsure if they're really going to be profitable. To me, they look good on PVGO standpoint because they're making a lot of investment and they're investing in the right things in my opinion. But just because you're investing in the right things doesn't mean it's going to actually pay off in the end. So for me, personally, I need to see some growth in some operating earnings and growth in cash flow. I need to see some gross cash flow, EBITDA, EBIT. I need to see some growth. And it doesn't have to be as high as the rate you're investing. But I also need to have confidence that that will change in time and that all your investments are going to pay off. So it's a little bit trickier, a little bit tougher to get a feel for that, especially since I give a lot of leeway to companies that are investing a lot in technology, a lot in R&D, a lot in their people. I cut them some slack, but I mean at the same time, if it's not paying off, I can't see the payoff, then we got a problem. The best way to mitigate between all these different approaches and styles and favoring one type of company over another is just to use multiple valuation approaches. So for myself, I use price to sales, DCF, and PVGO. I use all three. And it makes life a lot easier. If a company looks really good in multiple scenarios, through multiple filters, then it must be a really good company. It must be a really good company to pass through all the noise. Because what happens most of the time is, maybe for the DCF, it looks good. Price to sales, it looks horrible. For PVGO, it's okay. It's not the greatest. Price to earnings, it looks amazing. So if you can combine, mix and match between all these valuation approaches, you'll be surprised at what you'll find. Some things will really work out, some not so much. So just keep that in mind whenever you're investing. And that's all I have for today. Remember, different valuation approaches will help show different companies, different styles of companies. The best way to cut through that, just combine them all. Just look at all of them and see what you can find. Take this advice, let me know what you get, if the same companies are popping through or if you're seeing just different companies pop through. Let me know. I would like to know that this advice is really helping somebody. So, until next time, peace.